Okay, let's start. So the first lecture or the first part of this class is about equity. You can see that I have given you the four chapters from the textbook, which correspond to this lecture, right? So if you have any questions, if you have some difficulties in understanding some materials from the lecture note, you could read the textbook, find the correct chapter, and see how the textbook authors um, discuss or how they teach you, how they tell you how it works. Okay, so first, what is equity? It's really essentially a fancy name for stock, right? I guess most people have heard about stock, right? So if you have uncle, then your uncle potentially is investing some uh, firms, right? He could possibly say, hey, I have bought um, stocks of Amazon, or I have bought stocks of Google, right? In this case, um, Google's stocks are essentially Google's equity, right? So equity is just stocks. Okay. How do I go to the second page? Oops. Okay. So the first part is about equity basics. So basically, we will talk about several concepts. You can see that here we will talk about three different kinds of stocks. The first is common stock. The second is the preferred stock. And the third one is the ADR, that is American Depository Receipts. I would say the more important concepts are common stock and preferred stock. If we have time, we could talk about ADR. If we don't have time, well, we will just skip it. Okay, now let's first talk about common stock. So, what is a common stock? Well, it's just a security which represents ownership in a firm. Um, so you can see that the central word here is ownership, right? So let's say um, you have bought some stocks. Let's say you have bought some Google stocks, and you have, uh, let's say Google has a total of 100 shares, and you bought one share. In this case, you could say you have this 1% ownership of Google, right? So common stock represents ownership. Of course, this is really a very basic definition, which gives you basic understanding of what is a common stock. So you can see here, if you want to go one step deeper, you could see that common stock has some features, right? Our focus here is two main features. The first one is called residual claim. And if you wanted to see what is the central word here, now I can tell you, well, residual is the central word. It basically says that, well, you can make a claim, right, as a shareholder. If you have bought some common stock, you will become a shareholder. As a shareholder, sorry, as a shareholder, if you have some claim to this firm, you can only make your claim after some other stakeholders in this firm. So here it basically says, let's say if you have a claim on the assets and income of the firm, then you could only make your claim after bondholders, other debt holders, and preferred shareholders. It basically says you're the last line to claim anything from this firm. Um, the second feature is limited liability. Again, the important word here is limited. It basically means as a common shareholder, right? Uh, the worst case for you is you will lose all the value in your stock, right? This is called limited liability because when your stock becomes worthless, your investment essentially becomes zero, right? But you can see that there could be some worst cases. Let's say if this firm has a lot of debt, right? If you're liable for this firm's debt, then you will owe the bank, let's say maybe $1 million. And this is bad for you, right? This is worse than the case when your stock becomes worthless. So you can see that this is limited because you're not liable for this firm's debt, right? That's why it is limited. Again, you're not liable for the firm's debt, and the worst case, your stocks will become worthless. So your liability is limited at zero. Okay. One important basic skill is about reading stock market listings. And you can see that if you're making investment, you really need to read some tables. And this is a table. Here you can see this is the table which gives you a lot of information about these different stocks. So let me tell you the meaning of each column. First, you can see that this is a name. Well, this is easy. It's basically the firm's name, right? And then second column is a symbol. So this is a ticker symbol, right? Um, it basically tells you if you want to search a certain stock, you can use this symbol to find it. Now, the third column has a name close. It's basically the close price of a certain stock. So what is a close? What is a close price? Well, um, it's basically the price of the stock before the market closes. Now, this is the net change. So net change basically tells you uh, today's close price minus yesterday's close price, right? Now, volume. Volume is this, volume basically tells you the transaction volume. So here it tells you how many shares, right? How many shares have been changed hand between different investors. So let's say if you look at GAP, right, for this firm, um, the volume is close to 5 million shares. Now, 52-week high. So this column basically tells you if you look, if you look to the past, if you look to the past 52 weeks, what is the highest price, right? So basically you can see that for the first firm GAP, for the past 52 weeks, yes, for the past 52 weeks, the highest price of GAP was $40.64, right? You can see that it's actually significantly higher than today's closing price, $21.81. Now, 52-week low. Well, this obviously is quite similar to 50-week high. So if you, again, if you look to the past, if you look to the past 50 weeks, you ask what is the lowest price and see, and you can see here that for GAP, right, the lowest price is $21.11. DIV, what is this DIV? Well, DIV basically means dividend, right? It means uh, the last recent dividend from GAP is $0.92. Okay? So a basic understanding of dividend is you should see that if you have a certain share, if you have bought some stocks, then generally each quarter, um, the firm will give you some money, right? This is called dividend. Let's say if you have Apple, let's say each quarter, for one share, Apple will pay you $1. This $1 per quarter per share is your dividend yield. Now, yield is basically a dividend yield. Um, so what is dividend yield? Well, dividend yield is really dividend divided by stock price, right? You can try this formula here. You can see that if you divide 0.92 by the close price of 21.81, you will get 4.22. Now, PE. Well, we have not talked about PE yet. Uh, PE is basically um, price earnings ratio, right? So if you use the stock price and if you divide the stock price by earnings, then you get PE ratio. It's a very important valuation ratio, right? Generally, um, generally, people would use this PE ratio to think whether this firm is undervalued or overvalued. As I said, we have not talked about this yet. In the future, maybe in the next week, we will actually talk about PE ratio. Um, this is YTD percentage change. So it's basically year to date percentage change. How do you calculate this? Well, what you do is you will use today's close price, and you will divide this today's close price by uh, the close price on the first day of this year, right? This gives you the Y2D percent change. So, okay, let me give you a example. So let's say you wanted to calculate Y2D percent change, right? So you will get two numbers, today's close. Let's say today's close is $10. You will also find out, let's say January 1st close price, right? So this is the first trading day of the year. Let's assume January 1st is the first day of the first trading day of the year. Let's say you find out it's the stock price is $8. Now to calculate this Y2D year to date percent change, it's basically 10 minus 8 divided by 8, which is I don't know what I think it's 25%. So this is the 25%. Basically, it says from the first trading day of this year to the current date, the stock price has increased for 25%. Okay, we have finished common stock, so let's talk about preferred stock. So if you wanted to understand this from the name, then you can see that the central word here is preferred, right? So it is preferred because it has certain priorities compared with the common stock. So it has the following priorities. Oh, let's see, what is the priority? Oops. Okay, well, let's first talk about some other aspects of preferred stock. So first, it can be redeemable. It basically says, let's say you have bought some preferred stocks from Google. Then if this preferred stock is redeemable, then Google can actually retire these preferred stock on a certain date. What Google would do is, if Google wants to redeem or retire these preferred stocks, they will actually pay you some money to buy back these preferred stocks. Second feature is it could be convertible into common stocks at a specific ratio. Let's say if the contract of the preferred stock says preferred stock can be converted into, let's say, common stock at a 1-to-1 ratio, then you can see that on some day, these preferred stocks can be converted. The third feature is adjustable rate. Um, Basically, it means that the dividend of this preferred stock will be tied to some market interest rate. For example, the preferred stock could have a dividend yield which is equal to 3-month T-bill rate. So basically, if the 3-month T-bill rate increases, then the dividend of the stock will increase. Okay. Um, Now let's talk about the relationship between preferred stock, equity, and debt. So first, preferred stock is actually similar to debt. Well, because it promises to pay the preferred stockholders a fixed amount of income each year. So this is sort of like debt, right? Remember what is debt? When you're buying debt, essentially you will have a coupon rate. So coupon rate basically means that for every year you will get some interest according to this coupon rate. And a second point why preferred stock is similar to debt is there is no voting power attached to preferred stock. So if you're a common stock holder, you actually have this voting power. It basically means at some annual meeting, right? You can actually vote, right? Whether you wanted to retain a CEO, whether you want to increase the compensation of the CEO, whether you wanted to retain or fire this director. Um, Voting power is actually an important feature of common stock. However, as a preferred stockholder, you don't have any voting power. This is just like debt holders. Debt holders also don't have voting power. Now, second, preferred stock is also similar to equity. Why it is similar to equity? Well, because um, the firm has no obligation to pay you dividend, right? This is interesting because again, think about debt, right? If you're a debt holder, then the firm has obligation to pay you this annual coupon rate, to pay you this annual interest rate. If the firm does not pay, the firm will be in default, and this is problematic, right? However, as a preferred shareholders, if the firm has some financial difficulties, then this firm could stop paying you dividend without violating any contracts. Right? So you can see that this is just similar to equity. Right? As an equity holder, you could get some dividend, but again, if the firm has some difficulties to pay you dividend, the firm could just stop it. Uh, Another subtle aspect of preferred stock dividend is um, if the firm pays you dividend, dividend is not tax deductible for this uh, firm. This is different from debt, right? We have learned in corporate finance too. If the firm pays you interest, then this part of interest expense is tax deductible. That's why we talked about interest tax shield, right? Okay, let's move on. Oops. Oh, this is a mess. I'm really bad at using this iPad version um, PowerPoint. Okay. Oh, I have not talked about why preferred stock is called preferred stock. right? Why do we use the word preferred? Well, the reason is because preferred stockholders, they have higher priority over common shareholders. Basically, this means if the firm files for bankruptcy, preferred stockholders, they will get payment first before common shareholders, right? That's why they have higher priority compared with common shareholders. Okay, let's move on. Okay, let's talk about stock market indexes. Now, first, what is a market index? Well, it's really a number that measures a stock market or a part or a subset of the stock market. Um, the value of this index is calculated from the prices of stocks in the index. If you read your textbook, there are actually two ways to calculate the value of the index. The first is price weighted. The second is value weighted. I will skip these two parts because they're not super important in understanding stock market indexes. But if you have time, I would recommend you to read that specific section on how to construct stock market indexes. And our major focus today is about uh, knowing or to know what kind of major stock index we have, right? This is actually important because these days when you're making investment, sometimes you will want to buy some index fund, which is really a mutual fund which invests in stock market indexes. So if you want to buy index fund, you want to understand what kind of index you're buying into, right? So for Canadian market, we have these major indexes. The first one is it's called composite index. It's a very comprehensive index. If you use Wikipedia to check what is a composite index, then you can see that it will basically tells you that it's the major index for Toronto Stock Exchange. You will get the majority of public firms in Canada included in this composite index. And the second one is TSX 60. So it basically includes 60 largest public firms in Canada. And then you would also have this middle cap and small cap. So here cap means market capitalization. So middle cap basically means that um, these firms, the market capitalization of these firms are sort of in the middle tier. So they're not the largest firms, but they're also not the smallest firms. Now, small cap, of course, these are basically the small firms in the Canadian stock market. Then you also have this industry indexes. This is actually important. Let's say you want to invest in high-tech industry. Then you want to think, what kind of uh, high-tech indexes in Canada stock market I can find, right? So if you can find one, and if there is a index fund invests in that specific high-tech index, then you can make your investment. And then we also have this venture index. So this venture index is really a index which includes firms listed on venture exchange. It's a it's a smaller exchange compared with Toronto Stock Exchange, but it has this high growth potentials because venture exchange their main task is to list those small but high growth firms. Let's see. Okay, so here you can see this table which gives you the readings for these Canadian stock indexes. Again, you get the index name here, close price, and change, and daily change, right? We have basically talked about all these columns. Um, oh, we haven't talked about daily change. I mean, basically, daily change is just this percentage change. That is, use change divided by close price. Then you get this percent daily change. For for example, if you use this 3.42 divided by 779.66, you will get this 0.44%. Now let's look at US indexes. US actually has much more indexes compared with Canadian stock market. But the most famous ones, right? You guys possibly have heard all of them. The most famous three US index are this Dow Jones Industrial Average, right? This Dow Index, and then SP 500, and third Nasdaq 100. So uh, Dow Jones, I think this index has 30 firms, right? So um, Dow Jones has 30 industrial firms. But nowadays, I think we have some firms which are not actually industrial firms. I think Apple actually is included in this Dow Jones Industrial Average. Obviously, Apple is a high-tech firm. It's not an industrial firm. Now, SP 500. So SP 500 is essentially the five largest public firms in the US market, and Nasdaq 100. So it's basically the 100 largest firms listed in Nasdaq exchange. Uh, Most of these 100 firms, they are high-tech firms. So if you want to invest in high-tech industry in the US, Nasdaq 100 is a nice candidate. Okay, now let's talk about the second part, which is the stock trading basics. So I have to say the second part is actually also very useful because when you want to make your own investment, you really need to understand these basic mechanisms, right? How to place a order, right? How to take care of margin requirements. Right? So these are very important topics and they're very useful. Okay, first let's talk about stock prices. Whenever people are talking about stock prices, it seems that it's a very simple concept, right? When you think about stock price, well, it's just a price, right? However, if you think carefully, it's not easy. First, you have different types of prices, right? So in the stock market, you have bid price and you have ask price. What is the bid price? The bid price is the highest price that a buyer is willing to buy a share of stock. The ask price is the smallest, the lowest price that a seller is willing to sell a share of stock. So now you can see that you have two different kinds of price. Um, Now, if if the buyer and the seller they can agree a price between the bid and the ask price, then a transaction will actually happen. And based on ask price and bid price, we have the bid ask spread. So it's basically the difference between ask price and bid price. And um, well, you can see the word spread here. This is a very common word in finance. It's really a fancy word for difference, right? So spread is really a fancy word for difference. Now let's see a table which gives you bid and ask price. So this is a actual. This is a obviously this is an actual firm. It's Facebook. So you can see that on this table, you can see you have bid price and ask price for Facebook. Let's see what numbers do we have here. First, we have the bid price. So on this left column, you have the bid price. And on the right column, you have the ask price. So let's see the first number, 118.34. So this is really, this number basically tells you the highest price these buyers want to buy your stock is 118.34. And you can see that the highest price is on the top, right? Because you can see that the second highest price is 118.33. Now, let's move to the right column, right? These two columns on the right, they give you ask prices. And then you can see that for this price, right? For this price, it basically says the lowest price these sellers want to sell is 118.36. Again, you can see that the lowest selling price is on the top, because if you move down, you can see that the ask prices, they go higher and higher. One thing you can see that the highest bid price is 118.34, and the lowest ask price is 118.36. You can see that ask price is larger than bid price, right? So you can see that ask is larger than bid. And you can imagine that at current price, there is no transaction, right? Because the lowest price people willing to sell is actually larger than the highest price people willing to pay, right? So no transaction can happen. And if you want this transaction to happen, then potentially there could be some buyers and sellers. They could agree that, well, maybe we could use the middle price, right? So maybe another or some other buyers, they are happy to make the purchase at 118.35, and some sellers, they could potentially say, okay, I am happy to sell at 118.35. If both the buyers and sellers, they can agree on a common price of 118.35, then the transaction can happen, right? And you could also see that the difference between ask price and bid price is, well, this is easy, right? The difference between these two prices is 0.02, right? So it's 2 cents. So this is essentially the bid ask spread. Okay, let's, oops. Okay, this one is, yeah, this one is hard to use. Okay, so after talking about different types of prices, let's talk about different types of orders. If you actually trade stocks, then you can see that there are actually more than 10 types of orders you can use. But the basic format of orders, it is actually very simple. So you have mainly two kinds of orders. The first one is called market order. The second one is called limit order. What is market order? Well, judging from the name, right, it has the word market. It basically says you want to buy or sell the stock at the market price. And if you submit a market order to your broker, then the market order will get executed immediately. There is no delay in executing your order because you're happy to pay whatever the market price is. Okay? To be more specific, if you're the buyer and if you submit a if you submit a market order, you will pay at least the ask price. If you're the seller, you will sell at most at the bid price. And you can see that I have these words here, right? At least, at most. Okay? Later, you will see why you have these complications, why you could only sell at most at the bid price. Later, you will see a example which will exactly tell you how this works. Now, the second type of order is limit order. Again, judging from the name, you can see that if you submit this limit order, you will put a limit on what? Well, you will put a limit on the price you wanted to pay or on the price you want to sell. Right? The third related concept is limit order book. So if a bunch of buyers and sellers they submit limit orders to the broker, then all these limit orders will be aggregated. So if these limit orders they are waiting to be executed, these aggregated limited orders will be called limit order book. I know at this stage, these concepts actually seem quite vague. So we will see a example, and I hope this example will help clarify what is a market order, what is a limit order, how these orders can get executed. Okay, let's move to the next slide. Oops. Okay, now let's look at this example. I think this is a very helpful example. Now, the first question is, if you look at this limited order book, right? Based on this limit order book, remember, limit order book is a collection of limit orders waiting to get executed, right? And these are all limit orders. Why these are limit orders? Well, because these orders they are waiting to get executed. So, for example, this is a limit order, right? This is a limit order. Okay. See, this is a limit order. Basically, this guy, right? This guy says, okay, I want to buy 200 Facebook shares, but I want to put a limit on the price I want to pay. The highest price I want to pay is $118.34, right? So this is a limit order. Now, based on this limit order book, let's solve this example. Right? The first question is, what is your purchase price of Facebook if you place a market order of 50 shares? Now let's move back to this table and think about this question. Right? Let's think about this. Okay, let me remove these. Okay. Now, remember, you place 50, you place this market order to buy 50 shares. You're the buyer. And we have talked about this. If you place this market order, your order will get executed immediately. And you will pay the ask price, right? Remember, you're the buyer. You want to buy 50 shares. So you have to pay the price the sellers they want to sell, right? So you will essentially make your purchase at this price. Again, remember what is this price? This is the lowest price these sellers want to sell you Facebook shares. And you're placing this market order and you wanted to exit and you want your orders to get executed immediately. So you have to pay this price. So the answer here is 118.36. Now, second question. What is your selling price of Facebook if you place a market order of 50 shares? Now let's see this, right? Now you're this seller, right? You want to sell your Facebook shares and you have placed a market order. Again, we have talked about this. If you're the seller and you have placed a market order, then you have to pay at this price, right? So you will sell at $118.34. Right? So the answer here is 118.34. Now, the third question is, what is your bid ask spread? Well, this is actually easy, right? We have learned about this. The difference between bid and ask is bid ask spread. So it is 118.36 minus 118.34, which is 2 cents. Right? Now, let's look at more complicated questions. What is your purchase price of Facebook if you place a market order of 500 shares? If you compare, if you, oops, oh gosh. So if you compare this question to the previous question, you can see that everything is the same, except now you're buying more shares, right? You're trying to buy 500 shares instead of 50 shares, right? So let's see what is the answer here. Now, remember you wanted to buy 500 shares. If you place this market order to buy 500 shares, again, you have to pay the ask price. So it seems that you will need to pay this price, right? However, you can see that if you pay this price, you will only be able to buy 300 shares because the first row basically says, hey, I am happy to sell 300 shares at $118.36. However, you actually want to buy 500 shares. Now, what can you do? Well, you will actually buy deeper into this limit order book. You will actually move down. You will actually buy 200 shares from the second or at the second price, right? So what is the answer here? Well, the answer here is okay, you will have two prices, right? So you will have 118.36. So you will buy 300 shares at this price. And you will continue to buy into this limit order book. In the end, you will buy the additional 200 shares at 118.37. Of course, if you wanted to, you can actually calculate the average price, right? So basically, the average price is 300 times 118.36 plus 200 times 11837 divided by 500 shares. Right? This gives you the average purchase price. Now, the last question says, what is your selling price of Facebook if you place a market order of 500 shares? Well, this is easy because we have finished uh, the 500 purchase price, right? So, I mean, 500 shares of selling price sort of the same. Okay, now let's see. Now you're the seller. Okay, let me first erase this. Now you're the seller, right? So again, we have talked about this. If you're the seller, you have to sell at the bid price. So first, you will sell 200 shares to this guy at $118.34. Again, you want to sell 500 shares. So you have to sell deeper into this limit order book. So you have to sell additional 300 shares at the price of 118.33. Now, what is the answer here? So you will sell 200 shares at this higher price, which is 118.34, and you will sell additional 300 shares at the lower price, which is 11833. Again, you can calculate the average selling price if you wanted to, right? It's just this weighted average price. Okay, I hope this example helps you to understand how market order and limit order work, right? This is important, as I said, because when you're actually trading stocks, you have the choice to either place a market order or a limit order. And you have to make your decision, which one do you want, right? And to make your decision, the first step is to understand what is a limit order, what is a market order. Okay, now let's talk about the trading cost. So there are two major categories of trading costs. The first one is explicit cost. It's called explicit because you can see it clearly, right? The explicit cost of trading refers to brokerage commissions. Basically, it means when you're trading stocks, you need to pay some fees, some trading fees to your broker. For example, in Canada, one of my brokers is Scotia iTrade. It's a very expensive broker. If you sell stock, you have to pay $9.99. And there are obviously other cheaper brokers. Let's say in Canada, if you use, I think it's called QuestTrade. So if you use QuestTrade, their commission is, I believe, it's about 4.99 Canadian dollars. Right? Now, the second type of trading cost is implicit cost of trading. It's implicit because it's more hidden compared with brokerage commissions. The first type of implicit cost of trading is bid-ask spread. We have talked about this bid-ask spread. Now the question is, why bid-ask spread is a trading cost, right? Well, it's easy. Think about it. Let's say the bid price is 2 and the ask price is 2.1. Let's say you want to do a round trip trading. That is, you want to buy and sell. Now, if you buy and sell at the same time, you can see that if you make your purchase, you have to pay a price of 2.1. Then, if you wanted to sell, you can only sell at a lower price of 2, right? Remember that if you place the market order, if you're the buyer, you pay the ask price. And if you're the seller, you pay the bid price. So basically, the bid ask spread will make you buy high and sell low. Of course, you lose money, right? So essentially, you can see that for this round trip trading, you will lose $0.1. The second important type of implicit cost of trading is market impact. As a small retail investor, market impact is generally not a concern to you. However, if you're a hedge fund, if you're a large asset manager, if you manage uh, tens of billions of dollars of assets, then it's a very, very important concern to you. Now, first, what is the market impact? It basically means that if you sell too many shares, you will push the market price down, right? Just think about it. If you sell 10 billion shares of Facebook within 1 minute, then obviously it's just like a flood. You're flooding this stock market with Facebook shares. So this selling pressure will push the price down, right? It basically means if you sell a lot of Facebook shares, you will sell at a very low price. You guys can actually see this implicit cost from this example, right? You can see that here, if you only place 50 shares, right, you can purchase at this $118.36. Now, if you make a larger purchase, 500 shares, then at least partially, you have to make a purchase at a higher price, right? So this 118.37, this higher price is really because of your market impact. It is the same to this second case, right? If you sell Facebook, right? If you only sell 50 shares, you can sell at this higher price, 118.34. And now, if you want to sell 500 shares, for this additional 300 shares, you have to sell at a lower price. This is a market impact, right? Because you have to sell at a lower price as a seller. This is bad for you. So this is a adverse market impact. Okay, that's for today's class. I think I have talked too much. So we will continue. So we will continue to talk about buying on margin in the next class.